Okay, let's unpack this. If you are stepping into the world of global finance, and specifically the foreign exchange market Forex, uh, you realize pretty quickly that everything rests on one single thing,
One core concept.
the currency pair. And we're not just talking about learning a new word here. We're talking about the actual DNA of the entire system.
It's the single most critical piece of knowledge, really. If you can get your head around the pair, not just what it is, but why it acts the way it does, you're immediately ahead of probably 80% of new traders.
Right.
If you try to trade without truly internalizing this idea of relative value, the market is just going to feel, well, chaotic.
Arbitrary. Exactly. And our goal today is to give you a definitive shortcut on this. We're synthesizing a whole stack of material that breaks down the mechanics of how you read these pairs, the whole idea of value relativity.
And crucially, how they're categorized.
Yes. Majors, minors, and exotics.
Mhm.
Because which category you're looking at, that basically determines your risk, your costs, and frankly, whether you should even be trading it at all.
We've got sources here covering everything from the textbook definition to the cold, hard math of what happens when you try to execute a trade in an illiquid market. The whole structure is unique.
Mm-hmm.
And that uniqueness, it comes from a core paradox we have to hit right at the start.
The paradox being, you never trade one thing by itself. I mean, in any other market stocks, real estate, oil, you buy the thing. You want Apple stock, you buy Apple stock.
But not in Forex.
And Forex, you have to buy and sell at the exact same time. You buy euros by selling dollars. The trade is the relationship.
And that's the mission today, mastering that relationship. By the time we're done with this deep dive, those confusing symbols on your screen, like Euro USD, are going to transform into a logical comparative ratio that you can actually analyze with confidence.
So let's dive right into that fundamental difference. When you buy or sell a typical asset, let's say a barrel of crude oil, the transaction is singular. The value of that barrel is X dollars. End of story.
But Forex just completely rejects that idea. A currency's value isn't intrinsic. It's a fiat instrument. It's backed by sovereign debt, political stability, economic output.
But not by gold.
Not by gold, not anymore. So it doesn't have this inherent universal worth like an ounce of gold does.
Yeah.
Its worth is entirely contextual. You have to trade the relationship between two currencies. You are always exchanging one for another.
So you can't just log onto your platform and say, I'd like to buy €1, please.
No. You have to buy the euro against something else. Maybe it's the US dollar, so you trade your USD, or maybe it's the Swiss franc, Euro CHF. And this forces us to address the bedrock of this entire market, the relativity of value.
The reason the pairing exists is, well, it's almost philosophical, isn't it?
It is. It's rooted in this idea that value only makes sense through comparison. We saw a fantastic, really simple analogy in the sources that just cuts right through all the complexity.
The Apple analogy. Yeah, let's use that. If
Yeah.
I just walked up to you on the street and asked, is an apple expensive? What would you say?
Well, my immediate reaction would be to say it's an incomplete question. Expensive compared to what? You haven't given me the other side of the equation.
Exactly. If we compare that apple to, say, a banana, it might be about the same. But if we compare the apple to 10 pounds, well, it's incredibly cheap.
And if you compare it to a car, it's essentially free.
Right. The value of the apple shifts dramatically, and it shifts based entirely on the comparison point, on the context. And this isn't just a quirky thought experiment. This is literally how currency trading works.
It's the absolute bedrock.
But let me push back on that for a second. An apple is just a fruit. A currency like the US dollar is backed by the GDP of the largest economy in the world. Doesn't that economic power give it some kind of intrinsic universal value? Why can't we just say the dollar is objectively strong right now?
And that's an excellent question. That's really where the confusion starts for a lot of people. While the underlying economy dictates the potential for strength, that potential is only realized when you measure it against the potential of another economy. Think of it like speed. A car's going 60 miles per hour. But that's 60 miles per hour relative to the road, which is fixed. The road is the reference point. In Forex, there is no fixed reference point. There are only other moving reference points.
So applying that, I can't just ask, is the euro strong? It's an analytically impossible question. It has no context.
Precisely. You have to complete the sentence. Is the euro strong compared to the dollar? Compared to the pound? Compared to the yen? And the answer will be different for each one because each of those is a different reference point.
And that is why the Forex pairs exist. EURUSD isn't two separate things on a chart. It's one single fluctuating ratio.
Yes. It functionally means euros, as measured and priced in US dollars.
So when I enter a trade, I'm not really betting on the euro to go up in some universal sense. I'm betting on the euro to perform better than the dollar over a specific period.
You're trading the relationship. The relationship is the asset. And that is the critical realization. Until you can see a currency pair as that singular fluctuating ratio, like a tug of war between two economies, the market will just never make consistent sense to you. You are always trading the differential.
Okay, so now that we get the why, this idea of relativity, let's get mechanical. Let's get into the how. We need the core instruction manual for reading the market. When you look at any pair, let's just stick with that classic example, EUR/USD. Let's say the price is 1.1650. What does that string of symbols and numbers actually mean?
Okay, so this sequence breaks down into three distinct parts, and you absolutely have to know what each one does. If you skip this, you will misinterpret price movement constantly.
The first currency, EUR in our example, that's the base currency.
Correct. That's the asset you're measuring, and it is always standardized to exactly 1 unit. It's your reference.
€1.
1 euro. Then the second currency, the USD, is the, quote, currency. Some people call it the counter currency. This is what you're using to measure the base currency. It's the price tag.
And the number itself, the 1.1650, is the answer to a very specific question.
It is. The question is always, how many units of the, quote, currency do I need to buy 1 unit of the base currency?
So EUR/USD at 1.1650 means to get 1 single euro, it will cost you $1.16.5. Simple as that. It's a direct exchange rate.
Exactly.
Let's use a completely different pair to really cement this because the structure is always the same.
Yeah.
How about GBP/JPY at 185.50?
Same rules apply. GBP is the base, so that's 1 unit, 1 British pound. JPY is the quote. So the number 185.50, it means 1 British pound costs 185.50 Japanese yen. The base is always 1. The quote is the variable price tag.
Okay, now before we even talk about that price moving, we have to define the unit of movement. That number, 1.1650, is going to be ticking up and down constantly. How do we quantify those tiny little shifts?
We use pips, and you have to know this term.
Right.
A pip stands for percentage in point, and it's the standardized unit of movement. For most currency pairs, it's the 4th decimal place. So if your USD moves from 1.1650 to 1.1651, that's a 1 pip move.
And your profit, your loss, the cost of the trade, it's all measured in these tiny increments, these pips.
And just a quick note, for pairs involving the Japanese yen, it's usually the 2nd decimal place.
Yeah.
So USD JPY from 145.50 to 145.51, that's also 1 pip.
And sometimes you'll even see a 5th decimal place. That's a pipette, a 10th of a pip, just for more granularity.
Yeah, but the main takeaway is that pips are like the miles per hour of the Forex world. They quantify the speed and the distance of the price movement.
Okay, that covers the definition and the unit of measure. Now let's talk about analyzing the movement itself, because this is where those two perspectives become so important for actually trading well. What happens when that price tag changes?
Right, so price movement always implies a shift in the relative strength of both currencies at the same time. When USD rises, let's say, from 1.1650 up to 1.17000, a 50 pip jump, that's one event, but you have to have two interpretations in your mind.
Perspective one is the obvious one, right? The base currency, the euro, got stronger. It now costs more dollars to buy 1 euro than it did before.
That's the simple reading. But perspective two is the one that requires a bit more thought. The, quote, currency, the US dollar, got weaker.
Oh.
Because the dollar is weaker, you now need more of them to buy the exact same thing, 1 euro. It's the same 50 pip move. But there could be two completely different economic stories driving it.
But hold on, isn't that just semantics? I mean, if the euro strengthens, why do I care if the dollar weakened? The chart looks exactly the same either way.
You absolutely have to care because your analysis, your reason for being in the trade, depends entirely on which story you believe is true.
Okay, explain that.
If the price goes up because the Eurozone economy is booming and the European Central Bank is hinting at rate hikes, that's euro strength, you might then forecast that this trend will continue.
I see. But if the price goes up because the U.S. economy is tanking and the Federal Reserve is panicking, that's dollar weakness?
Exactly. And your forecast then is driven by U.S. data and future Fed policy, which has nothing to do with what's happening in Europe. The movement is identical, but the underlying cause is completely different. A good trader is always asking, am I trading euro strength or am I trading dollar weakness?
Or both.
Or both. And if the price falls from 1.1650 down to 1.1600, it's the same logic in reverse. Either the euro got weaker or the dollar got stronger.
So a successful trader isn't just watching a line go up and down. They're mentally juggling two central banks, two inflation reports, two sets of employment data, and trying to figure out who's winning the tug of war.
That's it. That is what makes this different from just trading a single stock. This dual narrative capability is what separates sophisticated analysis from just spotting patterns on a chart.
That dual narrative brings us right to the next point, which is probably the biggest stumbling block for new traders. It's the thing that feels like a glitch in the matrix.
The beginner confusion.
Yes. How can a currency be both strong and weak at the exact same time?
It feels completely counterintuitive. I mean, if the euro is strong, it should be strong against everything, right?
Mm.
But because value is purely relative, that's just not how it works. If you hold on to this idea that a currency has some kind of singular absolute value, you will always be confused by the market.
Let's use the scenario from the sources to make this crystal clear. Imagine you open your trading platform, it's morning, and you see two things happening that seem to completely contradict each other.
First thing you notice, Euro USD is spiking higher, aggressively. Based on what we just discussed, that means the euro is getting stronger than the US dollar. The euro is winning that specific fight.
But then, at the same time, you look over at your GBP and it's falling, maybe even falling sharply, which means the euro is getting weaker compared to the British pound. The pound is winning that fight.
So there you have it. The euro is appreciating against the world's reserve currency, the dollar, but it's depreciating against its next-door neighbor, the pound. So, is the euro strong or is it weak?
And the answer is...
It's neither. It's not universally strong or weak. It only has value in context.
So for you, the trader, if you were just focused on the euro, you'd be totally lost. One chart is screaming buy the euro, the other is screaming sell the euro.
Exactly. The euro is strong against the dollar, and at the same moment, it's weak against the pound. The real key is understanding the relationship between the two other currencies, the dollar and the pound.
That's where you have to triangulate, right? If EURUSD is going up and Euro GBP is going down, it strongly implies that the British pound is having a moment of massive strength.
It's outperforming both of them. That's the proper interpretation.
Yeah.
The euro is just the constant, the reference point in two completely separate battles. One is being driven by U.S. news, the other is being driven by U.K. news. You realize you're not even trading the euro, you're trading two simultaneous economic contests.
That really is the aha moment. Once you accept that complete reliance on relativity, currency pairs stop being these weird, confusing symbols and they become what they are, logical comparison tools.
And that mindset shift is mandatory if you want to progress. It forces you to embrace analyzing two economies every single time you look at a chart. You can never just focus on one side of the pair.
Okay, so we've laid the foundation. We know what a pair is, and we know that relativity is everything. Now we have to move into the practical world of execution and risk because not all pairs are created equal. And this section is the longest and honestly probably the most critical for protecting your money while you learn.
Absolutely. The mistake we see all the time is, hey, my strategy works great on the euro, but it just got destroyed on this yen cross.
Well, yeah. The assumption that a strategy that works on EURUSD will work identically on, say, GBP JPY or USDT TRY is just. It's fundamentally wrong.
So why is there such a huge difference in how they behave? Why isn't every pair as clean and predictable as the majors?
It comes down to the sheer economic and technical infrastructure that supports these different currencies. That infrastructure dictates everything: market behavior, your costs, and the volatility. So before we get into the categories, let's just quickly run through the main drivers of those differences.
Okay, first is economic data differentials. A strong jobs report in the U.S. will probably strengthen the dollar across the board, but the size of that move will be drastically different against the Canadian dollar, which is tied to oil, versus the Japanese yen, which is a safe haven.
Then you have central bank policies. Interest rate decisions are the big one. If the Turkish central bank suddenly hikes rates from 15% to 20%, that creates a massive interest rate differential with the U.S., and it causes huge volatility in USDT TRY. A similar move by the European Central Bank would cause much more orderly movement in EURUSD.
Global risk sentiment is huge too, especially for exotics and safe havens. When global markets panic, say, a war breaks out, money flees risky assets and floods into traditional safe havens.
The US dollar, the Japanese yen, the Swiss franc.
Right, and that risk-off flow can drive those pairs hundreds of pips while absolutely crushing emerging market currencies at the same time.
And finally, you've got geopolitical events and commodity prices. These are very region-specific. A conflict in the Middle East sends oil prices flying, which instantly strengthens the Canadian dollar because Canada is a huge oil exporter. That driver has almost no immediate effect on the Swiss franc.
And understanding those variables helps explain why the exact same technical setup, like a breakout of a key level, might work perfectly on a major pair, but fail miserably or result in just account-destroying slippage on an exotic pair.
All right, so let's get into the first category. The gold standard, the foundation of the whole market, major pairs.
These are the pairs that involve the US dollar, the world's reserve currency.
The big ones, USD, GBP USD, USD JPY, USD CH, and the commodity currencies, AUD USD, USD CAD, and NZD USD. The USD is always in there somewhere.
And their defining characteristic is sheer scale, which we measure as liquidity.
Liquidity just means the depth of the market, right? How many buyers and sellers are active at any given price?
Exactly. And the major pairs trade in the trillions of dollars every single day. This massive depth means two critical things for you: tight costs and clean execution.
Let's talk about those costs. The spread. That's the difference between the buy and sell price. It's your cost to get into the trade. For majors, these are incredibly tight. We're talking zero point 0.6 to 1.5 pips during normal hours.
And a zero point 0.6 pip spread is basically nothing. It's negligible. It means you're only a tiny fraction of a pip underwater when you open a trade. The high liquidity guarantees there's always a big bank ready to take the other side of your trade at a tight price.
This high volume also leads to much cleaner price action. It's more predictable. When trillions of dollars are moving, it's very hard for one player to manipulate the chart.
That's right. The major pairs are known for respecting technical levels better. Support and resistance tend to hold more consistently. Chart patterns play out more reliably. There's just less random noise because the flow of money is so enormous.
Which is why they are universally recommended for beginners. It's not just about trying to predict the direction, it's about execution reliability.
And this is the point we really have to stress. In a major pair, your orders fill at the price you expect, which minimizes something called slippage.
Slippage is when you click to buy at price X, but the market moves so fast with so little liquidity that your order actually gets filled at price Y, which is often worse.
Right. On USD, slippage is rare. It usually only happens during huge news events, and even then it might just be a pip or two. Your stop-loss orders and your take-profit targets actually get triggered reliably because there's always a buyer or a seller waiting right there. They're just more forgiving.
So the advice is pretty clear.
The advice is absolute for anyone starting out. Start exclusively with USD. It is the most traded pair in the world, it has the tightest spreads, and there's more analysis available on it than anything else. Learn one pair deeply, understand its rhythms, how it reacts to US news, how it reacts to Eurozone news. Learn that before you even think about looking at another chart.
Okay, so that's the majors. Let's move up a level in complexity to the minor pairs, which are also called cross pairs.
And the definition here is simple. They are pairs that do not include the US dollar. The USD is taken completely out of the equation.
So we're talking about pairs like Euro GBP, Euro JPY, GBP JPY, Euro, that sort of thing. You're trading the direct performance between two major non-USD economies.
And the characteristics immediately reflect that dip in liquidity. Since the world's reserve currency isn't involved, the trading volume is significantly smaller.
And lower volume means more friction, higher costs.
Exactly. You see wider spreads, typically somewhere between 1.5 and 4 pips. That's already 3 or 4 times the entry cost of a tight major spread.
And the movement itself can be more erratic. They can whipsaw a lot more, where the price just jumps back and forth without a clear trend, simply because the institutional volume is thinner.
But the real reason they're harder for a beginner is that you are now analyzing two independent non-USD economies at the same time. The fundamental analysis just gets way more complex.
Let's use ERGBP as an example. To figure out where that's going, you can't just rely on the US dollar as your global benchmark. You have to be tracking everything happening in the Eurozone, everything happening in the UK, and the specific relationship between those two central banks.
Think about it. A surprise inflation report out of the UK could send the pound soaring, which makes ERGBP fall. But an hour later, the European Central Bank president gives a dovish speech, which weakens the euro and makes ERGBP fall even faster.
You're dealing with either compounding or conflicting effects from two separate news cycles.
And the market isn't going to wait for you to figure it all out. That's why the recommendation for miners is simple. Avoid them until you have a rock-solid, consistently profitable foundation on the majors. We're talking 6 months minimum. Get comfortable tracking one variable against the USD before you try to juggle two at once.
Which brings us to the final category, and the one we have to talk about with extreme caution, the exotic pairs. This is the real danger zone.
Especially for small retail accounts. Exotic pairs include a currency from an emerging market, like the Turkish lira, or the South African rand, or even a smaller developed economy like the Swedish krona. This is where the risk just goes through the roof.
So USD Turai, URZAR, USD
Those are the big ones. And their characteristics are the polar opposite of the majors. They have extremely low liquidity. And that lack of depth is the single biggest factor that makes them so risky and so expensive to trade.
Because of that illiquidity, the spreads are, well, they're astronomical.
But we're talking 5 pips on the very low end, stretching up to 50 pips, or even more during volatile times.
Let's put that cost into real terms. If you trade a standard lot on URUSD with a 1 pip spread, your entry cost is about $10. If you do the same on USD TRY with a 25 pip spread, your immediate entry cost is $250.
You are down a huge amount before the price even moves a single tick in your favor.
Yeah.
That cost structure alone makes any kind of short-term trading or scalping totally impossible.
And beyond the cost, there are 2 other massive risks: extreme political and economic volatility, and these crushing overnight holding costs.
Let's talk volatility first. These emerging economies often suffer from, political instability, sudden policy changes, unpredictable central banks. News that would be a tiny blip for the U.S. economy could send the Turkish lira on a 500-pip move in a few hours.
There's less analysis available, and technical patterns often just get run over by a big fundamental shock.
Totally. And then you have the swap costs, the overnight fees. This is the fee or credit you get for holding a position past 5 p.m. New York time. Why are these so extreme on exotics?
It's the interest rate differential, right?
Exactly. Emerging markets like Turkey often have incredibly high interest rates, 20, 30% or more, to fight inflation. Developed economies like the U.S. might be at 5%.
So if you're buying the lira and selling the dollar, you should get a huge credit.
In theory, yes. But here's the catch that burns beginners. Brokers often pass through a huge negative swap cost when you're on the other side of that trade selling the lira. The fees are so high that holding an exotic trade for just a few days can eat up hundreds of pips of your profit, even if the price is moving in your favor.
And finally, let's revisit that execution risk: slippage and gapping.
Because the order book is so shallow, so few big players, your orders suffer from severe slippage. You might try to enter a trade and your order fills 20, 30, even 50 pips away from where you clicked.
And worse, the price can gap.
It can gap significantly overnight or over a weekend. That means the market closes at one price and opens at a drastically different, much worse price, completely jumping over your stop-loss order.
So your main risk management tool, your stop loss, is basically useless. That's terrifying.
It is. So, to be blunt, exotics offers zero learning advantage. They introduce a ton of unnecessary variables, and their cost structure is designed to destroy small accounts. Avoid them entirely while you're learning. You need reliability and consistency, and exotics are the exact opposite of that.
This has been a really thorough deep dive into the very foundation of Forex. We've established that the market is all about relativity, we've mastered how to read the base and quote, and maybe most importantly, we've detailed the critical differences in risk between majors, minors, and exotics.
And I think the single most important mindset shift for you listening right now is about how you select a pair to trade. It has to be based on readability and consistency, not on excitement or finding the fastest moving opportunity.
That's the paradox you have to internalize. USD seems boring to a lot of people precisely because it moves slowly and predictably. It respects the analysis, you can trust your execution. That predictability is exactly why it is the perfect learning environment.
The moment a beginner gets drawn to USD ROI because it can move 300 pips in a day, they're setting themselves up for failure. That excitement is unreliable, it's expensive to trade, and that high volatility combined with slippage is what destroys small accounts.
Your criteria for choosing a pair have to be practical. Can I read this chart cleanly? Can I afford the spread? And, critically, can I execute my trades reliably without getting crushed by slippage?
The goal is consistent profitability. And consistency is found where liquidity is highest. Trade the majors. Your costs will be lower, your execution will be better, and your analysis will actually mean something.
We started by saying every currency's value is purely relative. To end this, let's take that idea and apply it to a really complex real-world scenario. A final thought for you to explore as you continue on your journey.
Yeah, this raises a fascinating question that really tests your understanding of everything we just covered: relativity, liquidity, and risk. If different economies respond differently to the same global event, How might a single major central bank decision, let's say an unexpected big rate hike from the U.S. Federal Reserve, how would that play out simultaneously across all three pair categories?
Okay, so that single Fed decision hits the market. It directly impacts the USD, instantly making it stronger. So your USD, a major, begins to fall, probably in a fairly predictable, orderly way. Right. But now look at EUR-JPY, a minor. That stronger dollar might cause global markets to panic a little, a risk-off move. That could push traders into the safe haven yen.
So now the URJPY chart gets really complicated because the euro is being measured against a currency that's reacting to the consequences of the Fed hike, not the hike itself.
Precisely. And finally, that same Fed hike absolutely detonates a pair like USD Troy Tri, an exotic. The stronger dollar causes capital to flee vulnerable emerging markets.
Which amplifies the existing volatility and sends USDTRY spiking upwards, probably causing massive slippage and blowing out anyone who was short the pair.
And to truly understand that complex ripple effect, how one Fed announcement creates three totally different market reactions in three different types of pairs, that requires understanding not just the U.S. economy, but all the mechanics of relativity, liquidity, and execution risk that we just covered. That entire ecosystem is what you need to master next.